Do not look at the price. That's the first rule, because the price lies. What you need to look at is the shape. Right now, on the screen in front of you, there's a single candle. Tall, violent, unnatural. A thin body, a massive vertical spike shooting straight upward. And then, just as quickly, a collapse. To most people, this looks like volatility. To traders, it looks like panic. To the media, it's just another wild market day. But to anyone who understands market structure, this candle is not normal. This is a shooting star candle, and shooting stars do not appear by accident. They appear at the end of something. The moment that shouldn't have existed in a matter of minutes, silver didn't rise. It teleported. One moment, price was stable, hovering, controlled, almost boring. The next moment, silver exploded vertically, piercing levels that had taken years to approach. No consolidation, no healthy buildup, no logical progression, just raw vertical force. The price flashed above levels that most traders had only seen in historical charts. And then, just as suddenly, it was gone. The drop was savage, fast, relentless. Billions in paper value erased in minutes, and the candle that remained behind, frozen in time, told a story no headline wanted to explain. Because this was not retail buying. This was not news-driven enthusiasm. This was structural violence inside the market. Why this one candle matters more than years of data? Markets speak in patterns, and patterns repeat because behavior repeats. A shooting star candle forms when buyers push price aggressively higher. Liquidity appears suddenly at the top. Sellers overwhelm demand, and price collapses back down. On the surface, it looks like failure, but underneath, it's distribution. This candle tells us that someone used that vertical move not to buy, but to sell. Large positions, hidden positions, positions that needed an exit, and retail traders, late, emotional, euphoric, provided the liquidity. That's how the game works. The illusion of a free market. We are taught that prices move because of supply and demand. That is the fairy tale. In reality, modern markets move because of liquidity hunts, derivative pressure, algorithmic triggers, forced margin liquidations. Silver is not just a metal. It is an industrial input, a monetary hedge, a geopolitical weapon, and most importantly, it is one of the most manipulated markets in financial history. That is not speculation. That is documented. Fines, admissions, court cases. Yet the manipulation never stopped. It just evolved. The role of paper silver. For every single ounce of physical silver, there are hundreds of paper claims, futures, contracts, options, swaps, unallocated accounts. Silver trades not as metal, but as promises. And when price spikes violently upward, it threatens the entire paper structure. Because at a certain level, paper breaks, and physical demand takes over. That is the one thing the system cannot allow. Why the spike had to be killed. That vertical move was dangerous, not because it was high, but because it was fast. Speed removes control, speed triggers, margin calls short squeezes, delivery demands, physical shortages. If silver had stayed above that spike level, even briefly, the narrative would have changed. Mainstream attention would have followed. Institutional fear would have ignited. Physical buyers would have rushed in. So the move had to be stopped, immediately, violently, without explanation. And the perfect tool? A sudden rug pull. Who loses in this game? New investors see the candle and panic. They believe the rally is over. They believe they were wrong. They sell at the worst possible moment. Experienced traders recognize something else, a liquidity event, a transfer of wealth, from emotional hands to disciplined ones. This is how markets reset before the next phase. The psychological damage is the point. The purpose of this candle is not price. It is fear. It is designed to break confidence, create doubt, force. Weak hands out. Reset sentiment. Markets do not move to reward belief. They move to punish it. And only after punishment do they move higher again. The question no one is asking, everyone is asking, did the bubble just burst? That is the wrong question. The real question is, why did price need to spike so violently before falling? Healthy markets do not behave this way. Controlled markets do. What this candle is really signaling. This shooting star candle is not an ending. It is a warning shot. It tells us pressure is building. Control is weakening, suppression is becoming more aggressive, and aggression always increases right before failure. The system is telling you something, but only if you know how to listen. Forget everything you think you know about how markets work, because what you are watching on your screen is not a natural system. It is not free, and it is definitely not fair. Modern financial markets are engineered environments, carefully constructed arenas where price is guided, pressured, and sometimes violently forced in directions that serve interests far larger than the average investor. What happened during that explosive silver candle was not chaos, it was execution. The myth of random volatility. Mainstream analysts love one word: volatility. It sounds scientific, it sounds neutral, it removes blame. But volatility is not random, not at this scale, not with this precision, not with this timing. Large vertical moves followed by immediate collapses are signatures, fingerprints left behind by mechanical systems interacting with human emotion. Algorithms don't panic, they don't hesitate, they don't hope, they hunt. The liquidity. Hunt explained liquidity is oxygen. Without it, markets suffocate. And liquidity is created when people place stop losses, margin positions, and leveraged bets clustered around obvious price levels. Those levels are visible, not just to institutions, but to machines. When price approaches these zones, something predictable happens. Stops get triggered. Forced buying or selling activates. Volume explodes. That explosion is not demand, it is extraction. The silver spike was a liquidity vacuum event. Price was forced upward to trigger short covering momentum algorithms, retail FOMO entries. Once enough liquidity was pulled into the system, the direction reversed, because the mission was complete. Who actually moves the market? Retail traders like to believe they matter. They do, but only as fuel. The real drivers operate on an entirely different level. Bullion banks, primary dealers, large hedge funds, sovereign-linked financial entities. These players do not trade charts. They trade flows. They don't ask, is silver cheap? They ask, where's the pain? And pain is always concentrated where leverage lives. The derivative, time bomb. Silver's real market is not physical. It is derivative-based. Futures contracts, options chains, swaps, and synthetic exposure instruments dominate price discovery. For every real ounce of silver, there are layers upon layers of paper promises stacked on top. This creates a fragile structure because derivatives depend on confidence, not metal. When price moves too quickly upward, margin requirements rise. Shorts face liquidation. Clearinghouses demand collateral. That threatens the entire derivative tower. So sudden spikes are tolerated only briefly, long enough to flush positions, never long enough to change the narrative. The role of exchanges and rule changes. When markets are truly free, rules remain constant. When markets are managed, rules change mid-game. Position limits adjust, margin requirements increase. Trading halts appear for stability. But stability for whom? Every sudden rule change during violent moves has one effect. It crushes overexposed traders. And guess who is always overexposed? Retail, the psychological engine. Markets are not moved by money alone. They are moved by belief. Every cycle follows the same emotional arc. Disbelief, curiosity, optimism, excitement, euphoria, shock, fear, capitulation. That silver candle was designed to short-circuit this process. Instead of letting optimism mature, fear was injected early. This keeps participation fragmented and weak. A united crowd is dangerous. A confused crowd is profitable. Media's role in the illusion. Notice the headlines. They never ask why. They only describe what. Silver spikes, then falls amid volatility. No investigation, no accountability, no structural explanation. Because asking why would expose concentrated short positions, systemic leverage, artificial price suppression. Silence is part of the architecture. Physical silver versus paper. Silver, there's a growing disconnect. Physical silver inventories are tight. Delivery times are stretching. Premiums remain elevated. Yet paper price suggests abundance. That contradiction cannot last forever. Paper markets can manufacture supply indefinitely. Physical markets cannot. And every violent spike followed by suppression tells the same story. Someone is afraid of price discovery. Why retail always arrives too late. Retail traders react. Institutions anticipate. By the time the average investor sees the breakout, smart money is already positioned. Liquidity zones are mapped. Exit strategies are planned. Retail buys excitement. Institutions sell into it. That silver spike was irresistible bait, and it worked. The hidden message in the collapse. The speed of the drop matters more than the size. Fast collapses erase confidence faster than slow declines. They create shock. Shock shuts down critical thinking. And when thinking stops, selling begins. This is not accidental. This is design. What smart money is actually watching, not price, not headlines. They are watching open interest changes, commitment of traders, data, inventory flows, delivery stress, cross-asset correlations. They are measuring strain, and strain is rising. This was not a failure. It was a test that Candle tested. How much buying pressure exists, how quickly fear can be injected, how efficiently price can be controlled. And every test teaches the system something. The more frequently these events occur, the closer we get to instability. Controlled systems eventually lose control, not suddenly, gradually, then all at once. The silver market is not broken, it is stressed. And stressed systems behave erratically before they break. What you witnessed was not the end of a move. It was the exposure of fragility. The most dangerous assumption. Assuming this was just another candle. History shows that the most important market events are dismissed in real time. They only make sense later, after the damage is done. The real question. Moving forward. The question is no longer, will silver go up or down? The question is, how long can this structure withstand pressure before something gives? Because pressure is no longer hypothetical. It is visible, it is measurable, and it is increasing. Every controlled system eventually reaches a moment where control becomes more expensive than collapse. Not overnight, not suddenly, but inevitably. What you're witnessing in the silver market is not a random sequence of events. It is a late-stage behavior pattern that has appeared again and again throughout financial history. The violence is increasing. The reactions are faster. The interventions are more aggressive. And those are not signs of strength. They are signs of strain. The final phase of suppression. Market suppression does not fail quietly. It fails loudly. At first, suppression is subtle. Gentle price caps, controlled pullbacks, narrative management. But as pressure builds, subtlety disappears. The market begins to spike violently. Interventions become visible. Price action starts to look unnatural, even to casual observers. This is the phase where the system is no longer guiding price. It is fighting it. Why speed is the enemy of control. Controlled markets rely on time. Time to adjust collateral requirements. Signal algorithms, coordinate liquidity providers, shape media narratives. Vertical price moves remove time. And when time disappears, mistakes happen. That is why explosive candles are feared. They compress days of activity into minutes, and systems built for gradual movement cannot adapt fast enough. Historical parallels. No one likes to discuss. Every major market failure shares common traits. Persistent suppression, rising leverage, increasing volatility, sudden rule changes, public disbelief, eventual rupture. This pattern appeared before. Currency pegs collapsing, commodity shortages, exploding bond markets, freezing banking systems seizing up. In every case, officials insisted things were under control until they weren't. Silver today fits this template uncomfortably well. The physical reality problem. Paper markets can fabricate supply. Physical markets cannot. Silver is consumed. It is not destroyed, but it is dispersed. In electronics and solar panels and medical equipment and industrial processes, much of it is unrecoverable. That creates a slow, invisible drain. And when physical availability tightens while paper claims multiply, tension builds. Eventually, someone asks for delivery. That is when confidence becomes irrelevant. Delivery is the system's weak point. Futures markets assume most contracts will never be settled physically. They assume rollover. They assume cash settlement. They assume trust. But when trust erodes, behavior changes. More participants demand delivery. More metal leaves, vaults, inventory levels drop. And suddenly, paper promises are tested against physical reality. This is the point of maximum vulnerability. Why violent moves are becoming more frequent. Frequency matters. Isolated events can be dismissed. Repeated events form patterns. The increasing frequency of violent silver moves suggests thinner liquidity, higher leverage, lower tolerance for price discovery. The system is becoming brittle. Brittle systems do not bend, they snap. The role of central bank psychology. Central authorities fear one thing above all else: loss of confidence. Silver is not just a commodity, it is a monetary signal. Rising silver prices imply currency debasement, inflation, stress, systemic imbalance. That is why silver is watched more closely than most assets. And that is why sudden price spikes trigger immediate reactions. The price itself is not the threat. The message is, what happens when suppression fails? Failure does not look like a smooth breakout. It looks like chaos. Expect gaps instead of trends. Illiquid trading windows, exchange interventions, contract modifications, emergency settlements. Price will not move politely, it will jump, pause, explode, and leave many participants behind. The wealth transfer. Event market resets are never neutral. They transfer wealth from leveraged participants, emotional traders, late entrants, to those holding physical assets, those without forced liquidation risk, those positioned before panic. This is not theory. It is history. Why most people will miss the move. Not because they are stupid, but because they are conditioned. Conditioned to trust official explanations. Fear volatility, sell during shock, chase confirmation. The biggest moves occur when participation is lowest. Confidence returns only after price is already far higher. The silver paradox. Silver is both a critical industrial metal, a monetary hedge. The dual nature makes it uniquely dangerous to control. Industrial demand does not respond to narratives. Factories do not care about futures curves. They need metal, and when availability becomes uncertain, they secure supply at any price. The signal hidden in extremes. Extreme price behavior is information. It tells us control mechanisms are under stress, liquidity is thinning, the cost of suppression is rising, markets are warning systems. They speak before headlines do. What a real break looks like. There will be no countdown, no announcement, no permission. The break will likely occur outside regular trading hours during low liquidity, on unexpected news or no news at all, because true structural failures never announce themselves. The aftermath will be confusing. After control fails, prices will overshoot. Corrections will be violent. Narratives will conflict. Blame will be assigned. But the structure will already be changed. And returning to the old system will be impossible. The most important insight. The most dangerous moment in any market is when everyone believes the risk has passed. Volatility appears contained, confidence returns prematurely. That is often when pressure is highest. This is not a prediction. This is not a call to action. This is an observation of patterns repeating, of structures straining, of systems behaving exactly as they have before failure. Not if something changes, but how. Gradual repricing, violent reset, structural overhaul. History suggests the answer is rarely gentle. Markets do not collapse because people expect them to. They collapse because people assume they won't, and by the time certainty disappears, it is already too late. Every system survives on one thing more than money, more than rules, more than power. It survives on belief. Belief that the numbers on a screen mean something. Belief that promises will be honored. Belief that control exists. The moment belief cracks, the system does not gently reform. It reconfigures through force. What happens after suppression fails is never clean, never fair, and never evenly distributed. It is chaotic. And silver, more than almost any other market, becomes a mirror reflecting that chaos back at the world. The moment after control fails. The failure of control does not announce itself. There is no siren, no press conference, no official admission. Instead, it shows up as confusion. Prices gap without explanation. Liquidity disappears. Bid-ask spreads widen unnaturally. Traders stare at screens that no longer behave as expected. And the first reaction is denial. This is just temporary. It never is. The immediate aftermath. Market behavior changes first. The first thing that breaks is normal market rhythm. You stop seeing smooth trends, predictable pullbacks, technical respect. Instead, you see sudden halts, random spikes, empty order books. Markets stop acting like markets and start acting like stress systems. Price no longer reflects value. It reflects urgency. Exchanges enter survival mode. When systems are threatened, institutions protect themselves first. Exchanges respond by increasing margin requirements, restricting position sizes, changing settlement rules, encouraging cash settlement over delivery. All framed as risk management. In reality, it is containment. They are not protecting traders. They are protecting the system from being exposed. The delivery problem goes public. For years, delivery stress lives in the background. Quiet, technical, ignored. After control fails, it becomes visible. Delivery delays are no longer rumors. They become notices. Then explanations, then excuses, logistical issues, temporary shortages, unexpected demand. The language becomes defensive because at this stage, physical silver is no longer just metal. It is proof. The two silver prices emerge. This is one of the most critical shifts. A split forms. Paper silver price, quoted, volatile managed physical silver price. Real, scarce, premium driven. They no longer move together. Paper price may fall violently. Physical price refuses to follow. Premiums expand. Availability shrinks. Dealers stop honoring posted prices. And suddenly people realize the screen price was never the real price. Why the public reacts too late. The public does not respond to signals. They respond to headlines. By the time mainstream media acknowledges unusual silver market conditions, the structural shift is already complete. Most people only act when banks limit withdrawals. Dealers say, out of stock. Governments issue reassurances. Reassurance is always late. Government language shifts. Pay attention to tone. Early stage, there's no problem. Mid stage, the system is stable. Late stage, we are monitoring the situation closely. Final stage, emergency measures are necessary. Language always escalates after control is lost. Never before. The monetary implication? No one wants to say out loud. Silver rising uncontrollably is not just a market issue. It is a currency issue, because silver historically exposes inflation debasement, loss of purchasing power. That is why silver suppression exists in the first place. Not to protect investors, to protect perception. When silver breaks free, the narrative breaks with it. Capital does not disappear. It moves. During systemic shifts, wealth is not destroyed. It is transferred out of cash debt instruments, over-leveraged positions into tangible assets, hard commodities, real value storage. Silver becomes a bridge asset, not because it is perfect, but because it is honest. It cannot be printed. The pain is uneven by design system. Resets are never democratic. Those closest to liquidity and power adjust first. Retail adjusts last. Pensions lag, salaries lag, savings lag. Assets move immediately. This delay is not accidental. It is structural. The role of fear after the break. Fear does not disappear after the system cracks. It intensifies, but it changes shape. Before, fear of missing out. After, fear of not having access to assets, liquidity, protection. That is when hoarding behavior appears, not just in metals, but in essentials. Silver as a confidence barometer. Silver's role after the break is symbolic. It becomes a trust indicator. When confidence in institutions falls, silver demand rises. When confidence stabilizes, silver consolidates. This relationship has existed for centuries. It never disappeared. It was only obscured. Attempts to reassert control. After the break, authorities try to regain narrative dominance, expect new regulations, position reporting requirements, market restructuring, rebranding of systems. The goal is not freedom, it is credibility restoration. Sometimes it works, often it doesn't. Why the old normal never returns. This is the part most people misunderstand. After a structural failure, markets do not go back. They move forward differently. Rules change, behavior changes, trust thresholds change. The illusion once broken cannot be repaired, only replaced. The new system emerges quietly, not in a single event, but through parallel pricing, alternative settlement systems, direct ownership models, reduced reliance on leverage. The new system grows in the shadows of the old one until one day it isn't the alternative anymore. It's the default. Silver's final transformation. Silver stops being just an investment. It becomes a hedge, a reference point, a psychological anchor. Not because it is magical, because it is finite. Who survives? System shifts not the smartest, not the fastest, but the least dependent on. Leveraged trust promises complex abstractions. Simplicity outlives complexity every time. The biggest lie that dies at the end. The lie that markets are neutral. They are not. They are constructed. And constructions fail. The last stage, acceptance. Eventually, panic fades, not because things are fixed, but because people adapt. Humans always do. A new normal forms. Lower trust, higher caution, more tangible value. Final message of the documentary. This was never about silver. Silver was just the signal. This was about control versus reality, paper versus substance. Belief versus truth markets can lie. Metal cannot. The question left for the viewer: when the screen stops telling the truth, what do you trust instead?